The majority of our Chapter 13 review and work has been on producing information for the statement of cash flows, which is a third major financial statement that we issue along with the income statement and the balance sheet. One of the problems with producing information for a statement of cash flows is that the majority of our work, majority of the financial records are basically created utilizing what we call generally accepted accounting principles. Generally accepted accounting principles are based upon accrual basis accounting, which is, as we've talked about, is different than cash basis accounting. In accrual basis accounting, we record an economic event when it occurs. In the case of cash basis accounting, we record the event when the cash transaction takes place. So we need to remember that the balance sheet and the income statement are based upon accrual basis accounting. And therefore, if the financial information, financial statements, is based upon accrual basis accounting, which is GAAP, we have to be able to convert that information to cash basis information to help prepare a statement of cash flows. So the remainder of this video is going to be talking about the methodology that we utilize to convert our accrued financial information accrued under GAAP into cash basis information. So let's take a look at the first slide on this. Okay, now one of the major areas of cash-based data is sales that are basically occur under accrued sales. How do we extract the cash that has been earned from accrued sales? What we have to do is we have to look at the relationship of our sales, accrued sales, to accounts receivable and to cash. And it's really not that hard, but we have to kind of learn where it comes from. Okay, there are two major phases to an accrued sale and cash collection cycle. The first one is we sell merchant goods or services to our customer, and we sell them on credit. In other words, they take delivery of the goods or services today and they promise to pay that amount in the future. So that's what we mean by on credit. So let's assume right now that these particular customers, or one customer, doesn't even matter, we sold them $100,000 worth of goods or services on account. In other words, with their promise to pay us later on. The journal entry would be debit to accounts receivable for $100,000, and the credit would be to sales for $100,000. Okay, that's the first major phase where we sell something to somebody on credit. The second major phase is basically when we collect the money based upon the previous sales on credit. So we take a look at B, and here in this case we collected $70,000 on account. So we've had customers pay us $70,000 towards their credit sales. So let's take a look at the journal entry in this. We're going to debit cash $70,000 and credit accounts receivable for $70,000. Now let's take a look at how the journal entry process works in this case. We're going to use T accounts. So the entry when we make the sale is we debit accounts receivable. That's our claim from our customer from our customer saying that they owe us this much money. At the same token, we credit $100,000 in sales. And again, notice there's no cash transaction. It's just a credit of the accrued sales. Okay, now we go to entry B, and our customers pay us. We receive $70,000 of cash, and we reduce our accounts receivable by $70,000, which indicates then that they owe us $70,000 less. And if we net the accounts receivable out at this point, we have a net accounts receivable balance of $30,000, meaning the customers still owe us $30,000 in cash. Now, from this point, Obviously, if we look at the cash account, we can tell how much cash we got. But let's assume right now that we cannot see the cash account. The only two accounts we can see are accounts receivable and sales. Utilizing the fact that these accounts are interrelated, we can still extract the amount of cash that was received on the credit sales. So let's assume again we have total sales of $100,000. We also know our accounts receivable balance is $70,000. So in effect, what's happened is our accounts receivable balance started out at zero, and by the time we added all the debits and credits, it ended up at $30,000. So we had an increase in accounts receivable of $30,000. Now we can compute the cash received even though we don't have the cash account. We take our sales of $100,000 and we received 70,000. We received sorry, we didn't receive 70,000. We basically then subtract the increase in accounts receivable of 30,000, which is due to our receipt of $70,000 in cash. So we take our sales of $100,000, and then we subtract out our increase in accounts receivable from 0 to 30,000, and the difference then happens to be our cash inflow, and you can see that is the amount of the cash inflow. Okay, now based upon that, let's go on and take a look at the this same transaction in another slide, and we're going to use, instead of the T accounts in terms of analysis, I'm going to give you a formula. And this formula again is, I'm not trying to turn you into an accountant, so this formula can be pretty helpful if you don't like working with T accounts. Also remember that this handout or this workbook that I've given you for chapter 13, this formula is contained in there, and you are free to bring your chapter 13 handout or workbook when you take your exam if you don't necessarily want to memorize the formula. Now I want to recreate the information from our previous page, and you'll notice we don't have any cash account information here, just accounts receivable and sales. I can use an item, this formula down here, to convert from accrual accounting to cash basis accounting. And here's how I do it. I'm going to take my sales and I'm going to either add to those sales or subtract from those sales based upon the increase or decrease in my accounts receivable. In this case, we had an increase of $30,000. And based upon whether it's an increase or decrease in receivables, you can see these notations right here. Basically, I'm going to add or subtract that amount from sales, and that's how I'm going to get my cash received from customers. So let's take a look. If we take one path, we're going to add something. If we take another path, we're going to subtract something. So we have to determine on these boxes which is an increase in sales or in receivables and which is a decrease in receivables. So we look at the top box. The top box represents the decrease in receivables. So if we have a decrease in our accounts receivable, we have to add that amount to our sales. The bottom box represents an increase in receivables. And if we have an increase in receivables, we have to subtract that increase from our sales. Now the nice thing is that this formula regarding converting accrued sales to cash works for all accrued sales. So once you have this formula, that's the same with the same boxes each time. So let's assume now, or I shouldn't assume, we have $100,000 worth of sales. Now we insert the sales in the sales box, $100,000. Now we have to assume, or we don't assume, but we have to determine whether or not we had a decrease or increase in receivables. And you'll notice here we went from a zero beginning balance to $30,000 balance in accounts receivable. So that would indicate that's an increase in receivables. So we'll insert that in the increase box. So we take our total sales, we subtract out our increase in receivables, and when we do that, we net that out to $70,000 with the cash received from customers. And you'll remember from the previous slide, that's exactly the amount that we had received from our customers. So this shows you, or helps prove to you, that the formula works. Let's try another problem using this exact same formula. Okay. Now, given these following financial statements, our balance sheet and our income statement, notice we have comparative balance sheets for accounts receivable. We have our 2017 ending balance, which becomes our beginning balance for 2018, and we have a 2018 ending balance. So now from that, we can compute the change between the two. And again, forgive me with my handwriting with my mouse, but the change is we had a $40,000 increase between 2017 and 2018. Also, I have my income statement for 2018 of $150,000. So this gives me all the information I need to compute the cash received from customers. I take my $150,000 in sales, and again, I have to determine basically which is a decrease box and which is the increase box. Okay, the important thing to understand is it's the same each time. My top box is decrease, my bottom box is increase. So now I see I've had a $40,000 increase in accounts receivable. So now I'm going to use that increase box, the bottom box. So I'm going to put $40,000 in there. So now I take $150,000 of sales minus my $40,000 increase, and I end up with cash received. Sorry about that. Cash received from sales. It's not coming out, but it would be, for some reason, the box wasn't disappearing. So the cash received from customers from sales would be $110,000. Okay, let's try one more problem utilizing this exact same formula. Remember, decrease is on the top, increase is on the bottom. Okay. Now we have a story problem, and we're going to solve the story problem utilizing the same formula. Mocha Joe sells coffee beans to coffee shops, and the company keeps its accounting records on an accrual basis. So we're told that we're doing accruals for our sales. During the year, the company recorded $850,000 worth of credit sales. Receivables at the beginning of the year were $350,000, and at the end of the year they were $350,000. So if we do the comparison at the beginning versus ending of the year, we see our receivables increase, that's a dollar sign by the way, by $50,000. Again, I forgive my writing with the mouse, but they increased by $50,000. We're also told that we have $850,000 worth of credit sales. So now it's a matter of plugging the information in this formula. So we take our sales of $850,000, and again, the top box is a decrease and the bottom box is an increase. I didn't label this time, I just wanted to show you. So in this case, we had a $50,000 increase in receivables. That was, we went from $300,000 to $350,000, so that's an increase in receivables. So we take our sales of $850,000 and we subtract out our increase in receivables of $50,000, and it comes out to $800,000. That represents the amount of cash that we received from our customers. So the company wants to know how much cash was received from sales during the year, and that's our answer. Okay, now let's go on. We've talked a bit about accrued sales. Now we're going to talk about the other side, accrued expenses. And again, when we do accrued expenses, we have to understand the relationship of accrued expenses to accounts payable and cash. And again, there's two major phases to accrued expenses. The first thing is we as a company are going to purchase some item or some items expense items. I'm just keeping them as expenses to keep things simple. We're going to purchase expense items on credit. In other words, we receive the benefit of the goods or the services today, and we promise to pay in the future. Okay, so that's the first phase. And when we take a look at the journal entry on this, it would be debit expenses and credit accounts payable 90,000. So that represents the accrued portion. Now we're going to take a look at the transaction where we use cash to pay off that accrued transaction, the accounts payable. So we're going to pay in this case $50,000 worth of our accounts payable. The journal entry in this case would be debit accounts payable and credit cash. So that represents us reducing our liability to creditors by $50,000, and that is a reduction. We paid people in cash for $50,000. So again, if we look at these two phases of the two major phases, the journal entries associated with these transactions, what we'll see is we're going to debit expenses for $90,000 and we're going to credit accounts payable for $90,000. Okay, entry B then is we're going to debit accounts payable for $50,000 and credit cash for the cash going out the door to pay off that accounts payable for $50,000. Now again, if we take a look at the net of accounts payable, that nets out to $40,000. So we have a remaining credit balance in our accounts payable account of $40,000. That represents money that we still owe. Now again, assuming that I did not have access to the cash account, I can use the information here between my accounts payable and expense accounts to extract that information. So I start off with my expenses of $90,000. From that then, I subtract my increase in my accounts payable balance of $40,000. And then that represents the net cash outflow to pay accounts payable, and you'll notice that agrees to the cash amount of the T account. Now we're going to go through this exact same slide again, but we're going to do it utilizing a formula that's very similar to that accrued sales formula we just did. As a matter of fact, it's exactly the same. The difference is instead of sales, we use expenses in this case, and instead of accounts receivable, we use accounts payable. You're also going to see when we do the decrease and increase, you're going to see the familiar, the decrease box is on the top, just like your sales formula, and the increase is on the bottom, just like your sales formula. So this is exactly the same thing. We just use expenses and accounts payable as opposed to sales and accounts receivable. So again, let's take a look at the top. We have accounts payable account and we have our expense account. So we're going to apply the information in the formula to basically the information in the T accounts to the information in the formula and compute the cash paid through accounts payable. So in this case, we take a look. Our total expenses are equal to $90,000 and that's inserted. Okay, then did we have an increase or a decrease in accounts payable? When you get down to it, it started at 0. We had an ending balance of $40,000. So we ended up with an increase in accounts payable, and that happens to be right there, $40,000. So we take our total expenses, subtract out our decrease in accounts payable, and the cash paid through accounts payable then nets out to $50,000, and if you'll remember, that's exactly the amount that was in our previous slide. Okay, let's try another example utilizing this formula. And again, we have comparative financial statements, and again in this case we have a balance sheet of 2017 and 2018. And you'll notice, so we had a change in the balance, and you'll notice that the amount of the change of 230 to 250 in our balance sheets, that means our accounts receivable increased in this case by $30,000. And again, I'm using my mouse for my writing. That was actually almost legible, $30,000 increase. I already know my expenses, $300,000. So now I can fill in my formula box. I take my total expenses of $300,000. I'm told here that I have an increase in accounts payable from 230 to 250. So that's, and I'm sorry I put the wrong amount in there. That amount that I should have filled in, that should be 20,000. That should be $20,000, not 30,000. Sorry for the math there. Now I know that I have an increase of $20,000. So again, picking out my slides, I have my decrease box is on the top, my increase box is on the bottom. I didn't bother labeling because I wanted you to try to remember those. So I'm going to then use my increase box by $20,000, and that's the difference is due to I started at 230 and at the end of the following year I ended up at 250,000. So it was an increase of $20,000. So my $300,000 of total expenses minus my increase in accounts payable is going to equal $280,000. So I know that the cash that I have dispersed through accounts payable for accrued purchases was $280,000. Okay, let's try one more example. Accounting principles, and remember, generally accepted accounting principles require accrual accounting. For some reason during the year the company experienced a cash shortage. Why? We're not told why, they just experienced it. So management wants to understand the amount of cash that was expended through accounts payable during the year. Okay, we're told that total expenses were $300,000, and remember we said this is on an accrual basis. As we say, all expense items were purchased on credit, which confirms it was on an accrual basis. During the current year, the beginning accounts payable balance was $550,000, so that's the balance they started out with. And the ending accounts payable balance was $400,000. And the question is, how much cash was expended through accounts payable during the year? Now, if we take that $550,000 and compare it to the $400,000, we started out at $550,000 and we ended up at $400,000. So that obviously implies we had a decrease, and the amount of the decrease was $150,000. So I'm going to again try to utilize a mouse to create some numbers. So $150,000, and I'm going to put here DEC for decrease, because our accounts payable went from $550,000 to $400,000. Now we have all the information that we need to fill in our formula. We have total expenses here. We show $300,000. Okay, now in this case we have a decrease in accounts payable. So that decrease was $150,000, and it goes in the decrease box, which is the difference between the $550,000 and the $400,000. So in this case we have a situation where we take our total expenses, we add to that then the $150,000 decrease in accounts payable, and we end up then with cash paid through accounts payable of $450,000, and that is the solution or the end to this particular problem. Okay, now let's go on with what I call the graduation exercise. We're going to talk about, we have a problem how to, number one, we're asked for the current year ended, what is the company's net income, what is the company's net cash flow, and what is the company's ending balance. We're also given here our formulas. We have our sales formula on the top, decrease and increase with net cash receipts. Then we have our disbursements formula on the bottom, decrease and increase with cash disbursements. And again, you'll see these formulas are exactly the same. We just have to substitute sales versus expenses and receivables versus payables. Okay, so let's read part of the problem. Okay, Firestruck Pottery commenced operations and they had $10,000 in their bank account at the beginning of the year. So this is what they started off with. Okay, there were no receivables or no payables at the beginning of the year, so those balances were zero. Firestruck keeps their financial records on an accrual basis, so we're told these are accrued balances. At the end of the year, the company had $60,000 in sales and $45,000 in expenses. Okay, there were no other income statement items. At the end of the year, the company had $5,000 in receivables and $10,000 in payables. Other than the company's cash balance, there were no other balance sheet items. So we're going to keep this very simple. Let's start off with entry B first, net cash flow. Okay, so again, we're looking for our cash receipts. So again, we're going to remember that we start off with our sales. We had $60,000 in sales. And in this case, we started off with 0 accounts payable, and at the end of the year we had $5,000 in accounts payable. So that means we had an increase in accounts payable of $5,000. So we take our $60,000 of $60,000 of sales. And by the way, I don't know if I said it should have been a $5,000 increase in accounts receivable. If I said accounts payable, I apologize. So we take our $60,000 in sales minus our $5,000 increase in accounts receivable, and the two net together means that we had cash receipts of $55,000. Okay, now let's take a look at the cash disbursement side. We're told that we had total expenses of $45,000 for the year, so we put the $45,000 in the expenses box. Now again, in this case, we had a $10,000 increase in payables. We started out at 0 and we ended up with $10,000. So we have a $10,000 increase in accounts payable. So again, if we do the math, we take $45,000 minus the increase in accounts payable, and we end up with cash disbursements of $35,000. Now we see we have cash receipts of $55,000 and we have cash disbursements of $35,000. So the net of the two means that we have positive cash flow. In other words, $20,000 of receipts over disbursements. Now let's go on and look at entry C, which is basically asking you what is the ending cash balance. And again, once you solve B, C is fairly simple. First of all, remember in the first part of this problem, the Firestruck Pottery commenced operations with $10,000 in their bank account at the beginning of the year. So we have a beginning balance of $10,000 we need to account for. The next item then is we have to account for our change in cash. And in this case, we have $20,000 more in receipts over disbursements. So we add that in, which means our ending cash balance at the end of the year would be $30,000. Okay, the last item that we need to solve would be our net income. And again, this is on an accrual basis. So all we need to do in effect is recognize, let me do a little bit different thing here. What we're going to do is we're going to recognize our total sales on an accrual basis. That happens to be $60,000. And we're going to recognize our total expenses, and again on an accrual basis, which happens to be $45,000. So let's go ahead and plug that number in this income statement. We have revenues minus expenses equals net profit. There's our $60,000 of revenue I just referred to, $45,000 of expenses I just referred to, ending up with we earned a net profit of $15,000. Now you'll notice again, because of the accrual factor versus cash collections in this particular case, we need to remember that in here we produced a net profit of $15,000, but in terms of our statement of cash flows, we actually had positive cash flows of $20,000. So you can see accrued basis income statement does not necessarily equal the statement of cash flows. With that, that is the end of the presentation. And guys, thank you so much for your time.